So, question 17. Which of the following is an advantage of private debt over public debt? And the options are: it does not require interest or in principal payments made upon it. That's not true. Both debts can have interest in payments. It is liquid. Again, not true. Private debt is illiquid. Public debt is liquid. That means whoever extends the loan can easily get rid of it, like sell a bond. So very liquid. It dilutes the ownership of the firm. Again, not. Ownership of the firm can be diluted only when shares are issued. D, it is sold to a wider group of investors. Also not. Public debt would be sold to a larger group of investors. And the last one, it does not need to be registered with the Securities Commission, and that is correct. Private debt doesn't need to be registered. It is less standardized. So answer is okay. Question 18. Which of the following statements is most accurate? The holder of a callable bond faces reinvestment risk precisely when it hurts, when market rates are lower than the coupon rate she is currently receiving. And this is true right away. This is the right answer. So that's kind of the drawback of the callable bond, that it is most likely to be called when the investor doesn't want to get rid of it, because the replacement bonds would have lower interest rates. But let's take a look at other answers. B, where when yields have risen, the issuer will choose to exercise the call on the callable bond. Again, that's not true. The bond would be called when the yields go down so that the issuer can refinance the debt at a lower rate. The issuer will exercise the call option only when the call price exceeds the prevailing market price of the bond. Again, that's not true. We want to call the bond at the lowest price if we're an issuer. Callable bond is relatively more attractive to the bondholder than the identical non-callable bond. Not true, because a bondholder faces the risk of the bond being called when it is inconvenient. And E, the issuer will exercise the call option only when the prevailing market rate exceeds the coupon rate of the bond. Again, this one is not true. So to summarize, question 18, answer A. Right, let's look at question 19. Supreme Industries issues the following announcement to holders of an issue of callable convertible notes. Prior to the close of business on May 17, 2008, holders may convert their notes into shares of Supreme Industries common stock at 33.25 shares of Supreme Industries common stock per $1,000 principal amount of the notes. Cash will be paid in lieu of fractional shares. On April 16, 2008, the last reported sale price of Supreme Industries common stock on NYSE was $21.60 per share. If on May 17th, Supreme Industries is trading at $24.60, what is the value of common stock? What is the value of a common stock a holder of $1,000 note would receive? So basically the question is, if you were to receive your share of common stock, if you decided to convert, what is the value that you would receive? And for that we need to look at, we have to look at common price of the stock, current price of the stock, which is $24.60, and the amount of shares that the bond can be converted to, which is $33.25. So if you were to convert, you would get 33.25 share, 33.25 shares at $24.60 per share. Sorry, then I sneezed. Anyway, which gives you $817.95, which is answer D. Question 20. Why do the issuers of bonds seek to increase the strength of a number of covenants in the bond agreement? Answer A is covenants favor the equity holders the managers work for. That's not true. Covenants are intended to protect debt holders. B, covenants force the company to renegotiate the terms of the bond if they're broken. That's not entirely true. They usually trigger, well, it's not true. They don't renegotiate the term of the bond. They usually force the company to do some decisions or stop them from doing certain things. They don't trigger renegotiation. Answer C, covenants increase firm's default risk. Quite the opposite, they lower it. Answer D, covenants can increase the flexibility of the company issuing the bond. That's not true. They reduce the flexibility because they kind of outline what's not supposed to be done during the life of the bond. And E, covenants lower the interest rate investors will require to buy the bond, and this one is true. That's why the companies may agree to certain covenants, because the benefit is to get lower rates for the bond they're issuing. Question 21. Parminder Partners is expected to generate free cash flows of $4 million per year for the next 5 years, after which they are expected to grow at a rate of 3% per year. The firm currently has $2 million of cash, $7 million of debt, and a cost of capital of 8%. If the firm has 10 million shares outstanding, what is Parminder's expected current share price? Okay, so I recommend to do this one in Excel, or of course, if you want, you can use a financial calculator. So I'm going to start by specifying what we know. So what do we know? Well, first of all, sorry, just my notes, so they're there. They're expected to generate free cash flows of $4 million per year for the next 5 years. So I'm gonna write down all the years we know something about and all the cash flows, which in case of this company is $4 million. And then after this, they're expected to grow at the rate of 3% per year. Okay, so basically, starting in year 6 and going forward, the cash flows will be equal to, sorry, I'm just going to write the growth rate after year 5, and that growth rate will be equal to 3% per year. So that implies that the free cash flow in year 6 will be equal to free cash flow in year 5 times 1 plus the growth rate. So free cash flow. Sorry. Times, sorry, I miswrote something. Let me, oh, you don't see my formula. Sorry, I need to move things around a little bit. Okay, that should be better. Okay, so the formula I used here is I take cash flow from year 5, multiplied by 1 plus the growth rate, and that gives me cash flow in year 6 of 4.12%. And basically that also means that starting in year 6 we will have a growing perpetuity. The firm currently has $2 million of cash, so I'm going to also write it down. So cash is $2 million. Debt is $7 million. And cost of capital, R, is equal to 8%. Oops. And also shares outstanding are 10 million. Okay, so the first thing I'm going to do is I'm going to compute terminal value. And terminal value would be basically the value of the growing perpetuity. And I'm going to compute it in year 5 because our growing perpetuity starts in year 6. So the terminal value would be equal to cash flow in year 6, which is 4.12, divided by R minus G, so divided by 8% minus 3%. And that gives me a terminal value of 82.4. Next step is to compute enterprise value. Enterprise value. Okay. And I can compute this as the present value of those payments here, plus terminal value. So basically terminal value is my cash flow in year 5. So enterprise value will be equal to net present value, net present value, where the interest rate is 8%, first value is 4, second value is 4, third value is 4, fourth value is 4, and the value in year 6 consists of 4 plus the terminal value. And that gives me net present value of 72.05. And then finally I can compute the price. And the price of the stock is equal to enterprise value minus debt, which is 7, plus cash, which is 2, and I divide it by shares outstanding. And that gives me a share price of 6.705, which is answer D, because 6.705 can be rounded up to 6.71. Okay, question 22. The Busby Corporation had a share price at the start of the year of 2620, paid a dividend of 0.56 at the end of the year, and had a share price of $29 at the end of the year. Which of the following is closest to the rate of return of investments in companies with equal risk to the Busby Corporation for this period? Okay, so basically, what are we given? We're giving the price today, and we know some cash flows from the future, that is dividend in year 1 and share price in year 1. So this is our very simple one period model where we can value the stock. Basically in one period model, price of the stock today is a present value of price of the stock 1 year from now plus dividend. In this case, we know all the prices and dividends, but we're trying to solve for R. If we rearrange this, we'll find that R is equal to P1 plus D1. So the cash flow from year 1 divided by P0 minus 1. So basically, shows you how the value of your investment increased in a year. So our R will be equal to 29 plus 0.56 divided by 26.2 minus 1, and that will give us 12.18%, which is, by rounding up, answer D.